Hello everyone and welcome back to the sessions on financial reporting. So friends, we have always been talking about one significant part of your syllabus that we will cover it someday, and today finally we find a good time, a good opportunity to begin with this topic, and I'm sure you will be excited about this as much as I am, and that is consolidated financial statements. So friends, going back to intermediate level, you have learnt a bit of consolidation at intermediate level, correct? Holding company, subsidiary company, control, consolidation of financial statements of subsidiary with the holding company. Now those basic things what you have learnt, that may serve as a little bit of background, but just a little bit. I would be okay if you have no idea about this topic, consolidated financial statements. It's okay if you have some idea, but what you have learned at intermediate level and what we are going to learn now, it has vast difference. So that was application of traditional accounting standards that were applicable in India at that time, and what we are going to learn now is application of Ind AS, and not just a single Ind AS. This standard will bring in connection around 6 different Ind AS, and how to link all these Ind AS into one concept what we are going to learn over here, that is basically consolidated financial statements. That linking is very important. So friends, this again is a big topic and you need to keep lot of patience again while dealing with this. Writing notes as and when we are progressing ahead is very important. So as usual, I will give you time to write notes. If you are not feeling like writing it, or if you have shortage of time and you want to skip writing notes, that could be just your choice. So let me give you a small recap of what you have learnt at intermediate with respect to consolidated financial statements. So you have generally observed that there are two different entities. One of the entity, which is a company, is acquiring shares in another company. So the company that acquires shares in the other company, it acquires so much of shares that it gets majority of the equity of the other company. In other words, the majority of the voting power, and the moment a company has majority of the voting power of the other company, it will be in a position to control that other company. So if X and Y are two companies and X purchases 70% of equity in Y, we can generally say, I repeat, we can generally say that X controls Y. So X will become holding company or parent company for Y, and Y will be considered as a subsidiary of X. And there begins a need to consolidate the financial statements of Y along with X. And there is a concept of presenting group financial statements where X and Y, these two entities, will be presenting their financial statement in consolidation. So basically it is X which will present consolidated financial statements with consolidation of its subsidiary Y. So just do one thing, pay attention over here. I am giving you this in writing, you may note it down, and then we shall go deeper into the subject matter. So the moment we speak of consolidation, what comes into our mind is existence of two different companies. One is X Limited, another is Y Limited. Consider the fact that X Limited acquires 70% of equity in Y Limited, and generally, I repeat again, generally when an entity has majority of equity holding in the other entity, it is considered to control that another entity. So here X Limited controls Y Limited. So what happens after this transaction of acquiring equity shares? X Limited will become the parent of Y Limited, and on the other side Y Limited will be considered as subsidiary of X Limited. So as per Ind AS 110, X Limited shall present consolidated financial statements. Friends, I want you to write this basic thing, even though you are very clear with it, but still write it down quickly. Alright friends, you would have finished writing this. Let us move ahead and now talk about types of financial statements. So we have individual financial statement, separate financial statement and consolidated financial statement. Let us first try to understand these three types of financial statements. Individual financial statements are financial statements of an entity which has no investment made in subsidiary or an associate or a joint venture. That means if there is an entity which has made investment in a subsidiary or has made an investment in an associate or has made investment in a joint venture, then comes the question of separate financial statements and consolidated financial statements. So when there is no investment in subsidiary, no investment in associate, no investment in joint venture, an entity would simply present individual financial statements. So question of consolidated financial statements or separate financial statements does not arise only because that entity has no investments of these three types. So friends, what I am trying to tell you is, among all the connecting Ind ASs, one of the Ind AS, that is Ind AS 27, applies on separate financial statements. That is why one should understand that keeping aside even the consolidated financial statement, you still have to deal with individual financial statement and separate financial statement. So how would you distinguish between the two? So individual financial statements simply represent the financial statements of an entity that does not have an investment in subsidiary or any investment in associate or any investment in joint venture. On the other side, when an entity has made investment in an associate or joint venture or has made investment in a subsidiary, then the investing company, which is typically called the investor, which could be either a parent in case of subsidiary, or in case of an associate it is simply called an investor. So such investor will have a need to present two set of financial statements, one where consolidation takes place, which is called as consolidated financial statement, and one where the investments of all these types are simply reported as investments applying other Ind ASs. We will talk about which type of Ind AS will apply on those investments, but what I am telling you is, think and understand this point very well. A company which has made investment in associate or joint venture or has made investment in subsidiary, these specific type of investments, when these are reflected in the financial statement of an entity, it will have a need to present two types of financial statements: consolidated financial statements and separate financial statements. What has to be done in which type of financial statements, we will talk about it, but I am trying to make you understand that individual financial statement is something completely different, where there is no question of any kind of investment of this type what we have just discussed arising. In other words, individual financial statements will not have anything to do with investment in subsidiary or associates or joint venture. So friends, what I have just discussed with you, I am going to show the same thing on screen over here. You may want to properly take note of that. One more thing before I show you that notes writing part, please pay attention to one more thing. When there is a parent company and the subsidiary of that parent company, which we have just covered in that previous example, so you would see that consolidated financial statement will be a need, correct? That means if X company is the parent company, it will present its separate financial statement, it will also present its consolidated financial statement, consolidating all the assets and liabilities of its subsidiary Y Limited. Now, if a company has no subsidiary but investment in associate only or investment in joint venture only, then the consolidated financial statements would mean application of a particular method of accounting for such investment, which we call as equity method. So friends, don't worry if you are having no idea about what is this equity method. Don't bother about it. We'll learn when the right time comes. What I am trying to tell you right now is something very basic. That is, an entity does not have a subsidiary, but it has investment in associate. So the investment in associated will be accounted for by using a particular method called equity method. So when an entity is using that equity method to report investment in an associate, even that financial statement will be considered as consolidated financial statement. So it may so happen that consolidated financial statements have to be prepared even though there is no subsidiary of the reporting entity. So friends, what I am trying to tell you again and again is, this theoretical concept is very important. Don't skip any part of this. Try to properly understand each point and note down everything systematically. So your attention on the screen while I show you the notes. So what we have just discussed, an individual financial statement is prepared by an entity that does not have a subsidiary, an associate, or an interest in a joint venture. The separate financial statements are statements of an investor where the investments in subsidiary, joint venture and associate are accounted for at cost or in accordance with Ind AS 109, that is financial instruments. The consolidated financial statements are the financial statements of a group in which the assets, liabilities, equity, income and cash flows of the parent and its subsidiaries are presented as those of a single entity. And then write a note that financial statements in which equity method is applied for investments in joint ventures and associates are also termed as consolidated financial statements. So friends, carefully take note of this whole thing and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us now talk about these types of financial statements. So the topic that we are learning is consolidated financial statement, correct? And obviously we have to also incorporate preparation and presentation of separate financial statements. Throughout the chapter there will be discussion about separate financial statements also. However, I am never going to further talk about individual financial statement other than this last point. So friends, imagine a company not having any subsidiary, a company not having any associate, not having any joint venture or joint arrangement. It will have no need for presenting consolidated financial statement. So question of consolidated financial statement or separate financial statement for such an entity will not arise. Such entity will simply present individual financial statement. That's all. Now onward, I am not talking about individual financial statements. So we have only two types of financial statements in the discussion ahead: separate financial statement and consolidated financial statements. So in all our examples ahead, there will be an entity which will have investment in either subsidiary or a joint venture or an associate, or will have a joint arrangement, or will have all of those arrangements, whatever. But it will have some of these types of investments, and therefore we will now first learn about how to deal with separate financial statements. Separate financial statements covered under Ind AS 27. So as per Ind AS 27, if these investments are to be presented in the financial statement, these are typically assets of the investor, correct? These are assets of the investor, and if you look into the nature of these assets, these are purely financial assets of the investor. Why? If you can recall what we have learnt in Ind AS 32 and Ind AS 109, that a financial asset includes investment in equity of another entity. So if you are holding equity instrument of another entity, it is a financial asset. And friends, financial assets are mainly dealt with under Ind AS 109. So as per Ind AS 27, that is separate financial statements, the investment in associate, investment in subsidiary, investment in joint venture, these types of investments will be reported little differently, either at cost or at fair value in accordance with Ind AS 109. I will not say a choice, but it is more of a situational thing. So if the investments of this type, that is investment in associate, investment in joint venture, investment in subsidiary, these type of investments are held for sale. That means they are not intended to be held for longer period of time. They are intended to be disposed of in near term or in near future. Then there is no point of consolidating all these types of investments. In other words, the financial statements of subsidiary associates need not be consolidated when the time horizon of that investment is so short. As a result, this type of investment, if it is not intended to be held for a longer period, in other words, if it is held for sale, Ind AS 105 will start applying, which has a title Non-Current Assets Held for Sale and Discontinued Operations. So Ind AS 105 will come into picture, and Ind AS 27 requires one simple thing, that if such investments are held for sale, they will be reported at cost in accordance with Ind AS 105. Matter ends. However, if they are not held for sale and are held for a longer term, that means then the objective of the investor is to keep drawing income out of that investment, and there comes the relevance of presenting consolidated financial statements. So what will be done in consolidated financial statements, we will talk about it later. But as far as separate financial statements are concerned, now in such case where the investor intends to hold these types of investments for a considerable time and not holding it for sale, that means these investments are not held for sale, then they will not be carried over at cost. These investments will then be carried over at fair value, and the changes in fair value will be routed through profit and loss, what we call as FVTPL type of investments, that is financial assets carried over at fair value through P&L. That will be the base of these investments to be reported in separate financial statement, and the standard that will apply for reporting such investments in the separate financial statement will be obviously Ind AS 109. So friends, what I want you to understand is separate financial statements, you will show these investments definitely as investments, right? So you will be classifying this investment into two categories. I am continuously talking about separate financial statement as of now, okay? So you will be classifying these investments as either held for sale or not held for sale. If they are held for sale, apply Ind AS 105 and carry over these investments at cost. If these are not held for sale, then apply Ind AS 109, carry over these investments at fair value, and the changes in fair value which will result into some kind of gain or loss because of the change in fair value, such gain or loss will be recognized in the statement of P&L, and of course in accordance with Ind AS 109. However, if we talk about this last category, that is consolidated financial statements, there will be multiple standards that will come into picture. Ind AS 110 for consolidated financial statements, where the financial statements of subsidiary will be consolidated with the parent. Then it will be Ind AS 111, that is about joint arrangements. Then it will be Ind AS 28 about investments in associate and joint ventures, and then there will be Ind AS 112 for disclosure of interest in other entities like subsidiary, joint ventures, associate, etc. So disclosure related standard is 112. So friends, when it comes to consolidated financial statements, I told you, you will have application of 4 different Ind ASs: Ind AS 110, 111, 112 and Ind AS 28. Not to forget one thing, what we have learnt in the previous chapter, that is business combination. Whenever there is the acquisition date and there is a case of holding subsidiary relationship building up at the acquisition date, you cannot ignore Ind AS 103. So for certain aspects to be measured and recognized at the acquisition date, that is the date at which the control is acquired, on such date Ind AS 103 will also apply, and you have learnt this already under Ind AS 103. So I am not going to make you learn Ind AS 103 in this chapter, but just telling you that there will be application of Ind AS 103 which should not be forgotten. But mainly what we will learn is Ind AS 27 with respect to separate financial statement, and 4 Ind ASs, I repeat again, Ind AS 110, 111, 112 and Ind AS 28 with respect to consolidated financial statements. So before we proceed ahead, let me give you a note on that and your attention on the screen please. So what we have just discussed, as per Ind AS 27, separate financial statements shall be prepared in accordance with all applicable Ind AS, except that it shall account for investment in subsidiaries, joint ventures and associates either at cost in accordance with Ind AS 105 if investment is classified as held for sale, or at fair value in accordance with Ind AS 109. Consolidated financial statements shall be prepared and presented in accordance with Ind AS 110, that is consolidated financial statements, Ind AS 111, that is joint arrangements, Ind AS 28, that is investment in associates and joint ventures, and Ind AS 112, that is disclosure of interest in another entity. So friends, write down these notes and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us now discuss something very important with respect to the point that you have written on separate financial statements. So what we have just learnt with respect to separate financial statements, that investment in subsidiaries, associates and joint ventures can be presented at cost as per Ind AS 105 if these investments are held for sale, or these can be carried over at fair value in accordance with Ind AS 109. Now this point what you have written over there with respect to separate financial statements, the adoption of carrying these investment at cost or at fair value, that is adoption of either Ind AS 105 or Ind AS 109, cannot be taken on investment by investment basis. This has to be taken for each category of investment. For example, if a company has a few subsidiaries, a few associates, a few different joint arrangements, now the company adopts fair value presentation for its investment in subsidiaries and it adopts cost as per Ind AS 105 for its investment in associates, permissible. However, if there are multiple investments in associates like A, B, C, and for associate A the company wants to apply Ind AS 105 and carry over the investment at cost because it is intended to be sold in near term, and other investment in associates are carried over at fair value as per Ind AS 109, this is not permissible by Ind AS 27. Ind AS 27 emphasizes on one thing, that adoption of Ind AS 105 and carrying the investment at cost needs to be applied, that policy needs to be applied for entire category of investment and not on individual investments. So let me give you this point also in writing. Please pay attention on the screen. So what we have just discussed, the entity shall apply the same accounting for each category of investment in separate financial statements. For example, suppose an entity that has investment in subsidiaries, associates and joint ventures can account for its investment in joint ventures at cost and investment in subsidiaries and associates in accordance with Ind AS 109. So this what you are reading is just an example given over here. However, if that entity has investment in two associates, it cannot account for investment in one associate as cost and investment in another associate in accordance with Ind AS 109. It has to choose either of the method for both the investments in associates. In simple words, this selection cannot be made for individual investments. The selection has to be for each category of investments. So friends, do one thing, please write down this note and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and talk about separate financial statements, mandatory. Now friends, understand one thing in this regard. Presenting separate financial statement is mandatory. That means an entity which is presenting consolidated financial statements cannot skip from presenting separate financial statement. Separate financial statement is mandatory. Presenting consolidated financial statement is a requirement over and above presenting separate financial statement. So, let me clarify this point in simple words. Suppose a company A Limited has a few subsidiaries, and because of existence of subsidiaries, it is required to present consolidated financial statements. It will have a need to present its separate financial statement compulsorily. On top of that, it will have to present consolidated financial statements. So, what can be exempted in rare cases is presentation of consolidated financial statement. Under no circumstances, presentation of separate financial statement can be exempted. That means presenting separate financial statement, there is no exemption. Presenting separate financial statement is a mandate. Now let me add one more explanation to this. Separate financial statement, as we just discussed, are mandatory. So sometimes separate financial statements could be the only financial statements to be presented. In other words, there can be no need for presenting consolidated financial statements. But under what situations there will be no need to present consolidated financial statements? Two situations. Situation number one, when the entity has been granted exemption with respect to presentation of consolidated financial statements. In other words, entity has been exempted from presenting consolidated financial statements. Or situation number two, the reporting entity is an investment entity. Now, investment entity over here means an asset management company or a mutual fund company. So, if you are talking about a mutual fund company, its sole objective is to collect money from its unit holders and invest the same in different securities. It may so happen that a mutual fund company may have bigger stakes in multiple companies. Now, you cannot expect that mutual fund company should consolidate all these entities. It is not going to serve any purpose because there is no line of connection in the business of those other entities in which this mutual fund company is the investor. So, an investment entity has been clearly exempted from presenting consolidated financial statements. Let us write some notes in this regard. Separate financial statements are presented in addition to consolidated financial statements prepared in case of a subsidiary or subsidiaries, or financial statements in which investments in associates and joint ventures are accounted for using equity method. Note: an entity may present separate financial statements as its only financial statements if it is exempted from preparing and presenting consolidated financial statements, or an investment entity, for example a mutual fund company, and apply exception to consolidation for all of its subsidiaries. Friends, write up this and then I give you some additional notes with respect to investment entity. Alright friends, you would have finished writing this whole thing. Let us move ahead and write some additional notes about investment entities. Change of status in case of investment entities. When an entity ceases to be an investment entity, it shall measure its investment in subsidiary either at cost, that is fair value of subsidiary at the date of status shall be considered as deemed cost, or continue to account for as per Ind AS 109. When an entity becomes an investment entity, it shall account for investment in subsidiary at fair value through profit and loss as per Ind AS 109, and the difference between the carrying value and fair value shall be recognized in profit or loss. So friends, write up this additional note as well, and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us go ahead and talk about exemption from presenting consolidated financial statements. Now friends, this is very important discussion that we have to carry out. Under what circumstances an entity can be exempted from presenting consolidated financial statements? So basically there are 4 conditions that needs to be fulfilled. All 4 conditions should be fulfilled. If an entity can fulfill all 4 conditions, definitely it will be granted exemption from presenting consolidated financial statements. But I repeat one thing, all 4 conditions need to be fulfilled, not one of the 4. So the first condition over there is the entity has to be an intermediate subsidiary. So before we take the discussion ahead and understand all 4 conditions, let me first explain you what is called an intermediate subsidiary. Consider a fact that X company holds 80% shares in Y company and Y company holds 70% shares in Z company. So what we can see over here is X has its subsidiary as Y and Y has its subsidiary as Z. That means X controls Y and Y controls Z. So eventually X also controls Z. So if you talk about the ultimate parent company in this chain, it is X company, correct? So X Limited is the ultimate parent company. What is the status of Y Limited over here? Y Limited is Z Limited's parent and it is X Limited's subsidiary. In the chain, it is at the midpoint where it is itself a subsidiary of its parent and it is parent of its own subsidiary. That means we call these kind of entities as intermediate subsidiaries. So first of all, only and only intermediate subsidiaries can be granted this exemption, but then not under all circumstances. If you can see over here, company X is holding 80% shares in company Y and we are trying to grant company Y exemption from presenting consolidated financial statements. So one typical condition is the ultimate parent has to present consolidated financial statements or has to make reporting in accordance with Ind AS 110. So if X Limited, the ultimate parent company, is presenting consolidated financial statements or it is providing a financial report in accordance with Ind AS 110, then Y Limited, which is the intermediate subsidiary, can be granted an exemption from presenting consolidated financial statement. And obviously, if you can see, if you eliminate X Limited from this picture, what will happen? Y Limited and Z Limited, just if you observe these 2 companies, then Y Limited is a parent of Z Limited, correct? In that case, Y Limited will have a need to present consolidated financial statement. So we are exempting Y Limited in this case. But what are the conditions to be fulfilled? So actually one condition what I have just mentioned is that in the chain, the ultimate parent company, which is on top, which in our example it is X Limited, must present consolidated financial statement or must present financial statements in accordance with Ind AS 110. Now if you can see, Y Limited is an intermediate subsidiary. It can be given exemption from presenting its consolidated financial statements provided it is a fully owned subsidiary of X company. But do we find Y Limited over here in this example as fully owned subsidiary of X? Answer is no. If it is not a fully owned subsidiary of X Limited, then there must be certain percentage of its share capital held by other parties. Those other investors will be so-called minority interest or minority shareholders or non-controlling interest. That non-controlling interest will have some problem with not presenting consolidated financial statements. So think from the perspective of a shareholder of Y Limited. Suppose I am a shareholder of this intermediate subsidiary Y Limited and falling in the category of that minority. I may have objection that, boss, simply because some other company is having major stake in this company, they are deciding not to present, I am getting affected. If they are deciding not to present consolidated financial statement, I am getting affected. I don't want Y Limited to take this exemption. In that case, Y Limited cannot take that exemption. Therefore, one of the condition is that in case that intermediate subsidiary is not a fully owned subsidiary of company X, then company X has to make sure that the other minority shareholders of Y company are informed that X Limited is presenting consolidated financial statements. So we are thinking Y Limited should be granted exemption from presenting consolidated financial statement. This information has to be given to the shareholders of Y Limited, that is those minority shareholders. Not just information has to be given, we need to obtain from them no objection. That means the minority shareholders should not have any objection. If they have objection, then the exemption cannot be granted. So friends, I have explained to you 2 conditions out of the 4 conditions. So one primary condition is the exemption can be availed only by an intermediate subsidiary. Exemption cannot be availed by the ultimate parent. Ultimate parent will have no choice, it will have to present consolidated financial statement. Now, the intermediate subsidiary can be granted exemption, but under fulfillment of other conditions. So, condition is it should be a fully owned subsidiary of ultimate parent, or if it is not a fully owned subsidiary, then those minority shareholders should be informed with respect to this availing of exemption with respect to Y Limited not presenting its consolidated financial statements, and those minority shareholders should not have any objections in this regard. So friends, I am sure you understand what is the meaning of this intermediate subsidiary. So Y Limited in this example is the intermediate subsidiary. Now can we notice one thing, that Y Limited is not a fully owned subsidiary of X Limited, because X Limited holds only 80% shares of Y Limited. That means there are other investors also involved in Y Limited as shareholders. So we can see one thing, those other investors who are having small shareholding, which is cumulative 20%, will be considered as a non-controlling interest or minority interest. What will happen? They have to be informed that Y Limited shall not present consolidated financial statement because the ultimate parent company X Limited is anyway going to present that consolidated financial statement, and investors or those minority shareholders or non-controlling interest should not have any objection in this regard. So friends, this is the conjunction of those 2 conditions that I have explained to you. Now 2 more conditions. Whichever company is availing this exemption should not be a listed company. If it is a listed company, no exemption can be granted. And 4th condition is it should not be in the process of listing. It should not happen that to a particular stock exchange it has applied for listing, or any kind of actions taken by that entity should not be in line of a process, or it is under a process of being listed. So friends, let me summarize these points for you. 4 conditions needs to be fulfilled. Condition number 1, the entity which is taking that exemption should be an intermediate subsidiary, not an ultimate parent company. Secondly, within that condition, it should be either a wholly owned subsidiary. If it is not a wholly owned subsidiary, then its minority shareholders should not have any objection with respect to this exemption being claimed. Second condition what we have discussed, that the ultimate parent company must present consolidated financial statements or should present financial statements in accordance with Ind AS 110. Third, the entity which is seeking this kind of exemption should not be a listed company. And fourth and last condition is it should not be in the process of listing. Now friends, I am going to give you these 4 conditions first in brief, then some explanation, and then you will write all these conditions in details also. So friends, let us do one thing, no skipping the notes writing part, okay. I am showing you all these notes over here, please write them. A parent who controls one or more entities is required to present consolidated financial statements. However, a parent is not required to present consolidated financial statements if it meets all of the 4 conditions. Condition 1, it is an intermediate subsidiary and its non-controlling interest do not object this exemption. Condition 2, it is not a listed entity. Condition 3, it is not in process of listing. Condition 4, the ultimate parent in the group is presenting consolidated financial statements or reporting in accordance with Ind AS 110. So friends, quickly write down these 4 conditions in brief, and then I'll give you notes in details as well. Alright friends, you would have finished writing these points. Let us write up these conditions in details. So beginning with condition number 1, the parent is either a wholly owned subsidiary or a partially owned subsidiary of another entity. Further, its other owners, including those not entitled to vote, have been informed and do not object to the parent not presenting the consolidated financial statements. Condition 2. The equity instruments or the debt instruments of the parent are not traded in a public market. The public market could be a domestic or foreign stock exchange or an over-the-counter market, including local and regional markets. So friends, write up these conditions in details also, and then we shall move ahead. Alright friends, you would have finished writing these two conditions. Let us move ahead and write up the other two conditions. Condition number 3. The parent has neither filed nor is in the process of filing its financial statements with a Securities Commission or other regulatory organization for purpose of issuing any class of instruments in a public market. And condition number 4. The ultimate or any intermediate parent of the parent that is required to present consolidated financial statements produces financial statements that are available for public use and comply with Ind AS in which subsidiaries are consolidated or are measured at fair value through profit or loss in accordance with Ind AS 110. So friends, write up these two conditions as well and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up some additional conditions. Further, a parent who fulfills the following two conditions is also not required to present consolidated financial statements. Condition 1, the parent is an investment entity, and condition 2, the parent is required to measure all its subsidiaries at fair value through statement of profit or loss.